In a strange twist, the Dow Jones and S&P 500 fall despite companies beating earnings season's expectations. I'll talk about why this happened and what you need to do, along with discussing Netflix, Microsoft, Alibaba, IBM and more. Hello and welcome to this week's US Stock Market Report. I'm Dale Gillham, Chief Analyst, Fund Manager and Trading Mentor at Wealth Within, and we are Australia's most trusted stock market educators. Now, just before I get into my thoughts on the US stock market, I wanted to say hello to anyone new to our channel. I do hope you enjoy our videos. Remember, if you have questions regarding US stocks, or you may even have a trading question that you need answered by an expert, please feel free to comment below, as I'm really happy to help you. Now, before we move on, show your support for the channel and hit that subscribe button and click the bell on the right of it so you keep up to date with my latest videos. Now, as I mentioned, the Dow Jones Industrial Average and the S&P 500 Index have closed down this week. That is despite 85% of companies reporting beating analysts' expectations. That's seriously strange. So why was this the case and what does it tell us? Now, with reporting season, we normally get increased volatility, which does not seem to have occurred. Rather, we're seeing indecision. Now, the main catalyst for the market's indecision in recent weeks has been caused by uncertainty. Investors have continued concerns over trade talks between the US and China, with many sitting on their hands and not daring to venture into the market, despite President Trump and China's Xi Jinping agreeing on the tariff truce at the G20 summit last month. Now, Mr. Trump, in his somewhat interesting and at times controversial style, said at the cabinet meeting in the past week that he could impose further tariffs on Chinese imports. Really? This is just telling us something we already know. China could also do the same, but where will that get anyone? The answer to this is not closer to a resolution, which is not what either country wants. Alongside this, there's also been increasing pressure on the Fed Reserve to cut interest rates, despite the overall positive outlook. Flat inflation rates in combination with the trade war threatening economic growth may push the Fed to cut rates at its next meeting, which in my opinion the market has already begun to factor in. One thing I know for sure is that if you listen to all the media, you'll not make smart investment decisions, as you will be too emotional and subjected to external biases. I believe that the overall outlook for the US market is positive despite all of the news. That said, I'd like to see the market pull back slightly over the coming weeks to find support for the next rise. If the market does continue to rise or consolidate sideways in the coming weeks, it could be an indication of a larger decline later in the year. Now let's take a look at some of the companies who reported this week and how they performed. King & Hill Microsoft reported their fourth quarter earnings on Thursday, with revenues up 12%, operating income up 20%, and the good news continued, yet the stock price was down 1.64% for the week. We'll take a look at the chart of Microsoft later in this report. Alibaba Group surpassed beliefs, reporting earnings of $1.28 per share, which was 23 cents above estimates. It also reported revenues up 51% from the prior year's quarter, along with shareholders approving a stock split that could boost shares ahead of a Hong Kong IPO. Its shares closed up just over 2% last week, and this one I'd keep my eye on for my watch list for the coming months. Now, IBM also had a better than expected trading update, reporting earnings of $3.17 per share. The outlook for IBM is positive after the company recently completed a $34 billion Red Heat acquisition in hopes of growing subscription-based software products online. IBM shares rose nearly 5% this week, and this is another one to watch. I'll talk more on this stock also when we check out the charts later. Netflix, on the other hand, was not so lucky, down more than 15% after reporting it had lost more than 100,000 subscribers in the US alone. However, Netflix is optimistic paid memberships will bounce back later in the year. Citibank kicked off the earnings season for the banks, reporting solid second quarter results, with $4.8 billion in second quarter profit. This is a lift of 7%. Citi also announced a share buyback, which is always good for a stock. Despite this, shares fell over 1% on concerns about future headwinds and net interest margins dipping. This year, Citi has been the top performing bank, up around 37% prior to earnings seasons. But look out for that one again at the end of my report. Wells Fargo, despite beating analysts' expectations, fell 3% over fears of a disappointing outlook, which overshadowed earnings. Flags of higher expenses and lower interest rates put pressure on the stock, which saw it trade below $45.20. Bank of America also beat expectations. However, its shares were flat due to announcing a capital return of $37 billion, share buybacks and special dividends. As for the investment bank, the news was still rather positive. Goldman Sachs was flat, even after the bank's bottom line exceeded expectations. JP Morgan's also exceeded expectations, reporting EPS of $2.82 a share, which was above the $2.50 estimate. Revenue also came in higher than expected at $29.57 billion, yet this one was down 1.5%. Looking at the S&P indices, materials was the best performer, however was just in the green, whilst consumer staples was not far behind it, being just in the red. Energy was down over 2.5% and real estate just over 2% for the week. The best performers in the S&P 100 top companies were Philip Morris, up over 8%, IBM up nearly 5%, followed by Abbott Laboratories just over 4% and Boeing just up over 3%. Netflix was the worst performer, down over 15%, CSX Corp down over 10%, followed by Schlumberger down just over 5%. So what do I expect in the markets this week? Well, let's get into the charts for our S&P 500 index update for this week. We'll also get into looking at some of those stocks of interest that I mentioned earlier.
Please remember that this report is an educational tool. While Wealth Within holds an Australian financial services licence, the information featured in this program is general in nature and therefore should not be relied upon. Before making any investment decisions, you should consult a licensed professional who can advise whether your investment decisions are appropriate for you. We hope that you enjoy this week's report.
Well, with reporting season, as I said earlier, we normally see a lot of indecision in the market, or a lot more volatility in the market, especially around this time of the year, because the market does have, generally the market will have a couple of lows every single year. So it'll go from low to high to low, and then low to high to low again twice in a year. So it gives you really good examples or really good opportunities to actually readjust your portfolios and have a good look at how strong or how weak the market is. Now, I do expect the Dow to come down, but I don't expect to be a massive fall. Like so many people are expecting this massive fall, and a lot of people are cautious about the market because of the news, around Trump and the China trade war and a whole lot of other different things. Now, interestingly, generally the opposite happens with the marketplace to what everybody else is saying. But let's have a quick look at the Dow Jones on the chart, and you can see here how it's broken through those previous all-time highs, and you can see how it did that quite significantly over the last week or so, although last week it did close lower from reporting season. That's not unusual. What we sometimes actually see when you see movements through a big resistance levels, you might see a move up and then it comes right back down onto that resistance level, and it's like it's creating a vacuum, and a lot of people wait for it to break through a resistance level, and all of a sudden it sucks up a lot of buying. The people are sitting above that, and then when they exhaust, it falls away a little bit. So it doesn't really worry me too much at this point in time. What's more interesting to me is we had 1, 2, 3, 4, 5 weeks up here. 1, 2, 3, 4, 5, 6 weeks up. So I would expect 1, maybe 2 weeks down and in that retest here. So if I have my little trend arrow tool, what I'm expecting is to see this sort of thing, a move up, a little bit of a move down, possibly below that all-time high a little bit, and then another move back up again. That's sort of what I would be expecting, to searching for a high. But it wouldn't surprise me if the Dow came down sort of 8 to 15% over the coming months. But right now I still think it looks more bullish for the medium term. I think it'll be bullish into 2020. Not too much to worry about, because really the US market, if we're talking about interest rates being dropped again, which we are, it means the economy is not pushing through fast. And if the economy is not building fast, then the stock market has plenty of value in that. And whilst a lot of people are saying it's overvalued or it's overheated, it's really hard to look at that chart and say, well, it is. Just because it's making new all-time highs, it's just going to slow down its pace at this point in time. Because remember, the Dow and the S&P 500 have really been the big movers over the past 4, 5, 6, 7, 8 years, or even in the last, since the GFC, they've been the bigger movers in world markets. Now it's just probably slowing down, because what happens is it's like swings and roundabouts. It will, the Dow and the S&P will overshoot other markets, and then it swings, it slows down, and the other markets pull up and they're faster. So right now I think the Dow's just slowing a little bit, but I don't think it's bearish. But let's go into look at some of the stocks that I mentioned during the report. Okay, the first stock we're going to look at is Microsoft, which we did talk about in the report. Obviously, it's, you know, with Apple, it's vying for that number one spot on the S&P 500, or the largest company in the world. And you can see why. It's just been an absolute gem of a stock to own for many years. I mean, since the GFC, it has risen phenomenally. It's up around $140 a share at this point in time, closing last week at $136 a share. So it does look really nice. The thing is, at the moment, it has, as I said last week, it gapped up and traded down, even though it had good news. But again, 1, 2, 3, 4, 5, 6 weeks up. Again, I just think it's doing what I think the Dow's doing. It'll probably come down maybe for another week or so. It'll probably come down to that sort of 130 area and then start to move back up again. But it does look like a very nice stock to own at this point in time. But would you be entering into it? You could enter into it, and as I said, as I always say, is put a stop loss underneath it. But while the sun's shining, you might as well be in a stock like this. It does look really good. Normally I'd go for stocks that have been falling away for some time and then picking them up on the new run, but it doesn't seem to want to stop, Microsoft, so it does look really good. Let's go into Alibaba. It's an interesting stock here. Now, Chinese stocks listed on the exchange are ones that I'm generally really careful of, simply because you never know the real story, given that they operate out of China, even though they are listed on the S&P 500. So you never know whether they're reporting accurately. Alibaba seems to be one of the better ones. Obviously, it's a bigger one, bigger known. So I would stay out of generally the more lesser known ones from a stock point of view, and actually owning those. But Alibaba does look a little bit interesting. It's quite volatile in a stock, but right now it is showing signs of strength. That it will or it may move up. So I think it's probably a nice little opportunity to have a good look at this stock for your portfolio. But if we do see it move up, and especially if it gets through that 177.95, it gets through to 178 or 179, then I would suggest it's moving up quite nicely, and it'll probably move through this previous all-time high here back at $211. So stick that one on your watch list, because I do actually like this stock, as I said, but I'm not a big fan of owning Chinese stocks on the exchange, because it's really hard to get great solid information, and more importantly that you can really trust from that point of view. Another big one, IBM. That one's been really slammed for so often, and we can see its all-time highs way back here in March 2013. So is this now the time that IBM starting to take off? And I think that the answer is absolutely yes. I think IBM is an even better buy than what Microsoft is at this point in time, given what we're seeing here on that monthly chart. It's moving up really nicely. If I use a trend line across here, you can just see how quickly it's really close to this sort of trend line, that it doesn't break above too often. So if it gets through this, then to me, I think it's going to head towards that all-time high, which is around $215, and it's currently at around $150. So a move up to that sort of level is quite a nice move in percentage terms from where we are. We can see like 30-40% up to that previous all-time high. So right now it does look really nice. It's fitting some rules for me to have a really good look at it. But here we go again, 1, 2, 3, 4, 5, 6, 7 weeks up. And last week was a pretty stellar week. So I wouldn't surprise me if we get a bit of cooling off this week, with maybe an inside bar or closing lower, or 1 or 2 weeks down. So if that does come down 1 or 2 weeks, using my little trend arrow tool, let's see if we see this happen over the next couple of weeks and it starts to move up. That would be the nice time to get in, because you're testing support, you're testing buying and selling pressure and everything on this stock. So at this point in time, I think IBM's the pick out of those 3 stocks that we've mentioned. Alibaba's also good. Let's have a quick look at Netflix, because I do actually like the FANG stocks, and I think they have got more to run. Netflix has been in a bit of a sideways consolidation for a few months, and we've had this big move down, but it really doesn't seem to worry me too much. Now, I'd like to see it hold, and if it can hold up around, let me just put a tool on here. if it can hold up around where it is, around that $308 mark, and start to move up, so not too much of a fall now and it starts to move up again, then I think it could be a really, really good buy for the medium to longer term, because if it does hold support there, if it breaks through this $308 level, then it will be heading for that around 260, 270 level at this point in time. So if you do own Netflix, I'd be putting it on my list of looking at it to whether I would need to exit that stock. If you don't own it and you're looking for a nice cheaper entry into it, then it could be coming over the next couple of weeks or in next month or so. Last one I wanted to look at from our report is Citi. Now Citi is a nice stock, and I just got a better day and load some more data for it. It didn't download. Citi is another bank, and it's been a bit bearish more lately, and you can see here how Citigroup has some resistance around that $72 mark, and we go back in history, you can see how its all-time high was way back here prior to the GFC, so it's had this massive fall. So there's plenty of upside on Citi if it does start to break above this sort of level here. Now if we go to this sort of level here, so $81, and we've got some resistance around 74, which is a bit above where it is right now. Breaking through these levels gives you plenty of blue sky, and that's what I'm suggesting, is not jump too early, but don't jump a bit too late. But right now I think if it gets through that sort of 74 sort of level, and if you do want to be really, really conservative, wait for it to get above that sort of $78 level before you get into this stock. But it does look a lot better at this point in time, and I think it might augur well. If the economy does start to grow, then Citibank will grow with it. I mean, banks tend to grow as the economy is growing as well. But that's it for me for this week's report. If you do want me to look at some US stocks for you or answer any questions about trading or investing, please comment below. I'm always happy to answer those, as I mentioned in my report. But that's it for me. For now, goodbye, good luck, and good trading.